Hi, I'm Patu from freefincal. Over the past few days, we've been seeing how sensitive even long-term SIPs are to market movements and how the performance of a mutual fund SIP over 10 years, 15 years depends sensitively on the value of the market at the end of the investment tenure or whenever you want to calculate it. And if you change that date by just a few days before or after, you can get very, very different return values. I want to I want to quantify this observation. I've given you several examples of this over the past few videos and articles. I want to quantify this observation in a slightly different manner. We're going to look at an SIP and we're going to look at a lump sum investment together, started on the same date, and we're going to find out which reacts to market changes more. Of course, this is not which is better, SIP or lump sum kind of argument. I'm not trying to say that, because nobody's ever going to invest only once in their life, because they will be making multiple investments over the course of 10 years, 15 years, 20 years, and that's some kind of an SIP. Because whether you do monthly SIP or annual SIP or quarterly SIP, the returns don't matter. So whether you invest 5 times, 6 times a month, or 12 times, 5 times, 6 times a year, or 12 times a year, it really doesn't matter much over the long period, over your entire investment tenure. It's just going to be one glorified SIP. So in essence, everybody is going to do some kind of SIP, whether it's automated or manual. So this is not a lump sum versus SIP kind of discussion, but I just want to highlight some risks associated with SIPs and how it reacts to market movements. So the first picture is we're going to track the return of a lump sum and a SIP made in April 2010, and we're going to look at the month. We're going to let the SIP run. We're going to do one lump sum investment on the first date of the SIP, and the SIP is going to continue, and we're going to check the annualized return of the SIP, the XIRR, and we're going to check the compounded annualized growth rate of the lump sum, which is the same as SIRR, this is the same as XIRR for the lump sum. We're going to check both of them and compare them month after month after month. So we're going to look at the progressive change in the XIRR or the CAGR. And you can see here the Nifty is shown in black on the right axis. The blue dots are the XIRR of the SIP, the progressive XIRR. The CAGR is shown in orange, and you can see here how both of them react to even small undulations in the market. And you can see when the market zooms up, the XIRR zooms up more, and then when the market falls down, the XIRR falls down a lot more. And that's a same falling down is much more after almost 10 years, more than 10 years. The SIP still falls down more than the lump sum investment. Because this doesn't mean much for which is better and so on. Don't ask me that question in the comments. There's no, that's just meaningless. But my point is that the the SIP is extremely sensitive to market movements, no matter how long the investment is made for. This is for a investment made in 2010 April. If you do the investment at the start of the bull run, somewhere around September 2013 or so, you can see here initially the XIRR is extremely high, but as the market slows down a bit and moving up and starts falling down a bit, you can see how it falls down by a huge amount. And then again in this latest market crash, you can see that the SIP has reacted much more sharply than the lump sum. So I just wanted to reiterate the fact that no matter your buying price does not matter. Even if you average the buying price month on month, it does not matter. It does not reduce risk. Don't look at an SIP as a risk reduction technique. It's not. Staggering investments will not help you reduce market risk. Also some people have said I'm looking at the worst case. Yes, when it comes to risk, you must always look at the worst case. You can cherry pick the worst risk to ensure that you are mentally prepared for that in future. There's absolutely no wrong in that. There's no bias in that, in my opinion. Thank you. Bye bye.